Welcome to the deep dive. Today we're diving into a stack of source materials, all focused on the latest, strategic and financial update from one of the big integrated energy companies. Specifically, their third quarter 2025 results.
Right. And our mission here, really, for you, the learner, is to cut through the usual corporate jargon and all these different numbers pretty quickly. We're looking at how this giant is actually trying to execute what's quite a complex dual strategy.
Okay, so where are they pushing for growth? Where are they maybe trimming back? And what do these key numbers really tell us about their long-term plan for creating value?
Exactly. Where are they growing? Where are they trimming? And what does it all mean?
So for the next few minutes, consider this your shortcut to understanding that tension, really.
Yeah.
Balancing the traditional energy growth side, what they call upstream, with this big push for efficiency and reshaping the whole portfolio on the downstream and customer side.
Yeah. And if you just look at the headline numbers for Q3 2025, the performance looks pretty strong. They reported $2.2 billion in underlying replacement cost profit and a very healthy operating cash flow of $7.8 billion.
Okay, that first number, underlying replacement cost profit. That sounds like jargon we need to unpack right away. What is that, essentially?
Well, think of it like this. For a company like this, the value of the oil and gas they have stored, their inventory, it swings around a lot with market prices, right? So replacement cost profit basically strips out that noise, that distortion caused by fluctuating prices on the value of the fuel they just happen to be holding. It gives you a much cleaner picture, sort of a truer look at the operational performance itself. How well the refineries actually ran, how efficiently the wells produced, regardless of whether oil prices went up or down that week. So that $2.2 billion, it's a pretty good, steady number for the quarter's actual operations.
Got it. So it's the profit from the doing, the running of the business, not just from sitting on inventory that suddenly got more expensive.
Precisely. Yeah, that's a good way to put it.
Okay, right. Let's dive into that core engine then, their growth strategy, the upstream business. The story here seems to be solid operations meeting some, pretty surprising exploration success.
Yeah, what jumps out right away is just the raw reliability.
Yeah.
Their upstream plant reliability hit 96.8% this quarter.
Wow.
In the world of massive, complex oil and gas infrastructure, running that consistently, that's genuinely world-class performance. And it directly supports, their revenue.
And that efficiency, it's not just about keeping things ticking over, is it? It's actually fueling their expansion plans. They started up 6 new major oil and gas projects in 2025 alone.
That's right, 6. And notably, 4 of those actually came online ahead of schedule.
Which, when you're talking billions of dollars per project, getting cash flow sooner rather than later, that's a big deal.
A very big deal. And look, that operational discipline, that's the foundation, right? It lets them actually commit capital to finding future resources.
Yeah.
And that future, based on these sources, it looks pretty bright on the exploration front. They've announced, 12 discoveries so far this year? Which shows they're, actively working to replace the reserves they're producing right now.
But the one that really grabs your attention is this boomerang discovery offshore Brazil. They announced it back in August. And the company's calling it their largest exploration find in 25 years. This isn't just another tick in the box. This sounds material.
Oh, it's absolutely material. The sheer scale alone gets your attention. The estimated area, the footprint of the field, is over 300 square kilometers. That's just huge.
Right.
But it's the rock quality, the geology, that's the real indicator of future value here.
And the quality sounds exceptional. They confirmed a remarkable 1,000-meter gross hydrocarbon column.
Yeah, 1,000 meters. And that breaks down, according to the initial analysis, to about 100 meters of, good quality oil, and then around 900 meters of liquid-rich gas condensate.
Okay, liquid-rich gas condensate. What does that mean in simple terms? More valuable.
Basically, yeah. It means the natural gas down there also contains a lot of valuable liquids, things like NGLs, natural gas liquids, which are easier and more profitable to process and sell than just plain dry gas. So yes, it adds significant potential value.
That makes sense. So not just big, but high quality, too. And they specifically mentioned, which I thought was interesting, that they think the carbon dioxide, the CO2 in the reservoir can be managed. That's often a big stumbling block, isn't it?
It is, absolutely. Dealing with CO2, especially offshore, can add huge costs and complexity, potentially delaying things for years.
Yeah.
So if they're already expressing confidence they can manage it, that really does sort of fast-track the potential development timeline in your mind.
Okay. Shifting gears just slightly within upstream,
Mm-hmm.
they also took a final investment decision, an FID, on the Tiber-Guadalupe project. That's in the Gulf of America, expected online in 2030.
Right.
Now, here's the question that jumps out, I think. Why commit billions now to a big oil project that won't even start producing cash until 2030?
Uh-huh.
Especially with, everything going on with the energy transition.
Well, that really gets to the heart of what these huge integrated energy companies are, doesn't it? They have these massive, incredibly long-lived assets and infrastructure and, well, obligations to their shareholders.
Mm-hmm.
A discovery like Boomerang or sanctioning a project like Tiber Guadalupe, it's critical because it helps ensure they have cash flow coming in not just next year, but potentially for the next 20, 30 years.
Mm-hmm.
It provides the financial stability they argue they need to actually fund their transition strategies over the long haul.
So it's like the bridge cash flow, funding the
Yeah.
future changes. And it looks like they're trying to build that bridge efficiently, too.
They are, yeah. The sources really highlight this. Tiber Guadalupe is expected to have development costs about $3 per barrel lower than its sister project, Cascadia,
$3 lower. How?
by reusing over 85% of Cascadia's design. Basically copying the homework, but in a smart way. That's significant capital efficiency baked right into a huge long-term commitment.
Okay. And one last point on upstream before we move on. There was movement on accessing some really historical resources. The government of Iraq activated the contract for rehabilitating the Kirkuk fields.
Yeah, the giant Kirkuk fields. That activation set an initial production baseline figure, 328,000 barrels per day.
That's a huge volume, potentially added to their future production profile almost overnight, isn't it?
It is, and it highlights another aspect of these companies, the access they sometimes have to existing globally significant resources and infrastructure. Kirkuk offers immense scale, but with, relatively lower exploration risk compared to going into brand new deep water territory.
Right. Okay, let's transition then. We've talked about finding new barrels, upstream growth. Now let's look at maximizing the value from what they already own, the downstream side. This feels like a different focus altogether.
Completely different focus. If upstream is about growth and expansion, downstream seems laser focused on relentless efficiency and slimming down the portfolio.
And they're getting results there too, right?
Absolutely. This is where they're delivering tangible cash flow improvements right now. Just look at the numbers again. Refining availability hit 96.6%. The company specifically flags this as the best quarter in 2 decades for their current refinery setup.
And when availability is that high, you're basically just running the plants harder, making and selling more high-margin products because they're not down for maintenance as much. That must feed directly into their cost goals.
It does, directly. It contributes straight into their big, ambitious, long-term cost reduction plan. They're targeting cutting their realized cash break-even point by $3 per barrel by 2027.
$3 per barrel. And what does that translate to in actual cash?
Well, that $3 reduction, they reckon, translates to roughly $1.5 billion of pre-tax operating cash flow improvement over the duration of the plan. So basically finding an extra $1.5 billion a year just by running leaner.
And it's like a permanent boost, right?
Yeah.
Year after year if they hit it. How are they doing on achieving that $1.5 billion?
Well, the sources confirm they've already delivered over 60% of that reduction just year to date in 2025.
60% already. Wow.
Yeah, they seem to be moving much faster than the timeline might suggest to fundamentally lower their underlying cost structure.
And we also see these structural cost reductions, SCRs, paying off too. They got about $500 million of new SCRs in the first 9 months of the year.
That's right. And that $500 million gets them to about half of their total downstream SCR target, which they're aiming to hit by 2027.
So these aren't just like temporary cuts.
No, this isn't just cutting back on, say, marketing for a quarter. These are structural changes, things like optimizing supply chains, maybe rolling out new IT platforms, simplifying how they manage different regions, stuff designed to stick.
Okay. And beyond just pure efficiency, downstream is also where we're seeing them actively reshaping the business, selling things off. They're ahead of schedule on getting rid of about 10% of their company-owned gas stations, their retail sites.
Yep. And they also mentioned they're moving at pace on the strategic review of their lubricants business, Castrol.
Right, Castrol. Why is shedding a well-known brand like Castrol potentially strategically important for an energy giant like this?
Well, it really comes down to simplification and focus. I mean, companies this huge, historically, they tended to accumulate all sorts of assets that were profitable, sure, but maybe not absolutely central to where they see their core future going. So reviewing Castrol or selling off some retail sites, it frees up 2 crucial things: capital, obviously, but also management attention. That focus can then be plowed back into the areas they believe will really drive long-term value. And the transition, think advanced fuels, EV charging infrastructure, or funding those massive upstream projects we just talked
So
about.
it's kind of trimming the fat to focus the muscle where they think it counts most.
That's a good way to put it, yeah. Trimming the fat to focus the muscle.
It's probably worth noting, though, it's not all smooth sailing. There are pressure points. That big acquisition they made, TA, Travel Centers of America, the trucks up, giant.
Right.
They're now implementing a specific business improvement plan, trying to boost free cash flow by $200 million to $300 million by 2027. Why are these truck stops suddenly under margin pressure?
Well, they're huge retail operations at the end of the day. And like pretty much all retail, they're sensitive to things like fuel margin volatility, operating costs, labor costs. So while buying TA strategically links into their view of future highway mobility, maybe hydrogen fueling, maybe next-gen biofuels down the road,
Okay.
actually integrating a massive retail operation like that, it takes time. The fact they're calling out margin pressure suggests they need to optimize its operations pretty quickly to make sure it meets the kind of investment returns they expect internally.
Makes sense. And outside their sort of core oil and gas operations, their bioenergy segment has hit some headwinds too. Something about Brazil.
Yeah, major external headwinds there. They flagged an expected 15% reduction in their 2025 crush volumes in Brazil. That's for things like sugarcane for ethanol.
15%. Why?
Purely weather impacts, apparently. Bad weather in key farming regions hit the crop yields. It's a classic example, really, of external risk you can't fully control.
Right.
It shows that even as these companies try to diversify into, lower carbon businesses like bioenergy, they essentially trade one type of volatility oil market swings for another type, like agricultural commodity prices and, well, the weather.
Okay, let's pivot one last time then to the financial framework that's sort of underpinning this whole dual strategy.
Yeah.
Because you need discipline when you're trying to expand and simplify at the same time.
Absolutely critical. And they reported their net debt is basically flat quarter on quarter at $26.1 billion, which is actually quite impressive when you consider what they did during the quarter.
What did they do?
They actively redeemed or paid back early $1.2 billion worth of hybrid bonds.
Okay, hybrid bonds. Paying those back early. What did that signal about their financial health?
Well, hybrid bonds are sort of a mix between debt and equity. Paying them off ahead of schedule is generally seen as a sign of balance sheet confidence. It reduces their future financing costs, it simplifies their overall capital structure, and it signals to the market, essentially, that their cash flow generation is strong enough to handle these kinds of complex debt cleanups without having to increase their overall borrowing, their net debt.
Okay, so a sign of strength. And that strength ties into their target, right? They keep emphasizing they're committed to getting net debt down into the $14 billion to $18 billion range by the end of 2027.
Right. That target is fixed, they say. And that fixed financial frame, it basically guides all their decisions about where to spend money. Their capital expenditure guidance, their CapEx, it remains pretty tight and disciplined. Around $14.5 billion for the full year 2025.
And looking further out.
Importantly, their multi-year CapEx plan for 2026 through 2027 is holding steady at $13 billion to $15 billion per year.
That stable range is pretty critical, isn't it? It suggests they're not suddenly going on a wild spending spree, but they are prioritizing those potentially high-return, long-term projects like Taber Guadalupe we mentioned.
Exactly. And this commitment to capital discipline, it then translates directly into how much cash they return to the owners, the shareholders. They're committed to returning 30% to 40% of their operating cash flow over time.
And what did that look like this quarter?
This quarter, that included announcing the regular dividend, $0.0832 per share, plus kicking off a new $750 million share buyback program.
So clearly trying to walk that line. Invest enough for the future, but keep shareholders happy with immediate returns today. Looking ahead just briefly then, what's the outlook for the final quarter of 2025?
For Q4, they expect upstream production to be broadly flat compared to Q3, so maintaining that high operational performance. In their customer segment, the downstream side, they anticipate seasonally lower volumes.
Which makes sense, right? Coming out of the summer driving season?
Exactly. Pretty typical. So overall, the kind of core message coming out of these results is, look, we're 9 months in. That's 3 quarters down of what we see as a 12-quarter plan, and we feel we're actually accelerating delivery and driving simplicity across the whole integrated business.
Okay, so let's try and wrap this up. What does this deep dive really mean for you as you try to process all this information? We've seen this core tension, haven't we? They're simultaneously placing these huge long-term bets on significant upstream growth. You see that with Boomerang, the scale of it, and the disciplined FIDs like Tiber Guadalupe.
While at the same time, in the shorter term, they're aggressively pursuing portfolio simplification. Think about the Castro review, selling retail sites, and really deep structural cost cutting in downstream to get more efficient. And we've seen that world-class operating performance, nearly 97% reliability in both upstream and downstream, being used almost as the bedrock, the foundation to support both sides of that strategy.
Right. They're actively managing a really complex portfolio, selling off bits, targeting these fundamental cost reductions to lower their break-even point. It really is quite the high-wire balancing act.
Which I think raises the final, maybe the most important question for you to really consider as you look at this company and the whole sector, actually. As the integrated energy industry tries to navigate this ongoing energy transition, can these massive companies successfully maximize their short-term cash flow and the returns from their existing long-life oil and gas assets, the current engine room, while simultaneously simplifying their businesses and shedding non-core assets? Can they do all that without ultimately damaging or cannibalizing their own future resource base or their growth potential further down the road?
That really is the fundamental trade-off, isn't it? The one this company and, frankly, the entire industry is trying to figure out right now. Keep those questions in mind as you explore this further, and we'll see you on the next Deep Dive.